Hi, good evening, all. Welcome, Pooja,
Good evening, sir.
Abhishek, and good evening, and Tushar on this platform. We have today GD on stock market, investments, and insurance. Under this topic, we are going to discuss majorly stock market, Nifty and Sensex, cryptocurrency, mutual funds, and insurance. The order goes this way. Pooja will be first discussing on stock market, and Tushar will be discussing about Nifty and Sensex and cryptocurrency. And then we have Abhishek will be talking about mutual funds and insurance. So that is the schedule for today or the program list for today. So let's continue. So Pooja, over to you.
Thank you, sir. So, as you all know, I'm Pooja, and today's topic is stock market. So, about stock market, it is something that's related to investment. Okay, so stock market is a place where you invest your money or your salary. So, coming to that, let's assume that you earn 50,000 a month and your expenses are 30,000 per month. So, how much do you save? Nearly 20,000. So, in a year, if you think there is 20 into 12, you will be able to save 2.4 lakhs. So now let's assume one more thing, that you work for the next 20 years and every year your income is grows at a rate of 10% per year. At the same time, I would introduce a term called inflation, also known as cost of living, or the increase in cost of living is called inflation. So inflation is at a rate of 8%. So at this point, so this year you have earned 50 into 12, which is 6 lakhs. So next year you will earn 6 lakhs because there's a 10% increase. That is, as I mentioned, led to an assumption that your income grows at 10%. So similarly, this year you're spending 30,000. So next year, with the same standard of living that you take, you will be spending nearly 32,400. So now, in 20 years, how much do you save? Nearly 1.7 crore. Things have become little interesting when crore came into picture, right? So now, if you stop earning, or if at all you stop working after 20 years, then the cost of living or the inflation is still increasing at 8%. That is not going to stop in the world. So, how much time will it take for you to spend this entire 1.7 crore, or at what time it will get exhausted? In 8 years, this complete 1.7 crore will get exhausted if you go with the same way of living or same way of spending with the same inflation and all of it. So, now instead, let's consider the same scenario in a little different way. So, instead of just keeping that or saving that 2,40,000, let us say that you are investing it in such a place where you're getting a 12% return or a 12% interest. So at this point, by the end of 20 years, this 2.4 lakhs is turning out to be 20 lakh plus. Okay. So if you add up the entire amount for the 20 years, then you will get somewhere nearly 4.76 crore. So now things got a little heavy as well, right? From 1.7 to 4.7. Okay, so this is why they say you need to invest. So now we know why should we invest, or what is the importance of at least having to invest, right? Okay. So now, so what are the reasons to invest? One thing, you save better. Next thing, you don't have to worry about inflation. Okay. So you don't have to worry about inflation for whatever reason, because you have earned something which is really great, and exhausting it would take really a long time. So it's fine. Now, talking about investing, there are four main domains where you can actually invest. The first domain is FD or bonds. This is a place where you have a fixed return in the market. So if they say that you need to get an 8% return or something like that, it is fixed. So how and or little more in depth about it, we'll be dealing it a little later. The second domain is real estate. So, for example, you buy a plot for 60L or 60 lakhs, and tomorrow, when you plan to sell that same plot, it might get sold at 2 crore or it might get sold at the same 60 lakhs. So, if you can sell it at 2 crore, that's your profit. But if not, if it stays at the same 60 lakh, then it's a loss. So, what is your loss? Inflation. In 10 years' time, if you plan to sell it, the tomorrow I referred to was a 10 years' time. So, 2 crores, because of the inflation, it has increased. Yes, you had profit. But if not, then your inflation is your loss because every year there is a growth of 8% in the market. So, this is a place where you just cannot predict profit or loss. Next, the third domain is equity, or another place like stock market. It's all connected more or less to stock market, and these terms we'll be discussing in detail further. So equity is a place where you get maximum ownership, or sorry, not ownership, maximum return. So what is equity? It is the ownership of any asset after clearing the liabilities associated with the same. So say, for example, there's a car, it is an asset. Okay, an asset is something that is valuable. So you have a car and say that it costs around 25,000 and your liability towards that car is 10,000. So what is your equity? 15,000. That is your asset value minus your liabilities. So 15, 25 minus 10, 15. So equity is you buy shares of a company. So what is a share? It is nothing but units of stock. So what exactly is a stock? It is a security that represent the ownership of that fraction in that corporate. So in that particular company, the security of it or the ownership security which is representing your ownership. So we'll be dealing more with these shares and things again little further. So in short, you can tell stock is also known as equity. So it's the same as equity. So the fourth domain of investment is metal investment. For example, gold, silver, etc. And approximately there's a return of 8%. So coming back to saving the 2.4 lakhs a year, if you invest it in an FD or metal investment, both the places you get nearly 8% interest. So your savings will be somewhere nearly approximately 3 crore, close to 3.1 crore. Okay. And real estate, it's not predictable. So we are not going to discuss that here. Coming to equity, if you're investing it in equity where you get 12% interest, then it becomes 5.4 crores. So maximum return is found here, but you need to be aware, you need to use your brains. It requires, because from 3 crore to 5 crore, what it takes, the 2 crore what it takes your brain. So stock market, what is a stock market? It is a market just like any other market, what you find for fruits, clothing, etc., where you buy and sell shares. So in any other market, you buy and sell other goods. Here, the good is nothing but shares. Now, to enter into stock market, you just cannot do it directly. You need a broker. So there are three ways of doing that. First is you directly meet a broker face to face in their office or so, and you discuss about it, and then you enter in. Or, as you can find it in films, a telephonic way of doing it. That is, you call up your broker and you tell this is what this many shares I want to buy or these many shares I want to sell, and your broker does that transaction. The other method, the third method, which you and me, all of us can very easily do, is through apps or applications or softwares which are available. Through these apps, you can do it. So coming to these apps, this is something that you can do it online. Because it acts as a portal or it creates a domain space for you. In the app, you go and sign up and it creates a domain or a portal like how you can have a web portal or any other portal or domain. This will provide that, and it acts as a broker, as an intermediate. You can conduct all your transactions. So now, till 1996, share certificates were issued, which were hard copies or on paper. So, what is a share certificate? Once you buy a share or you sell a share to somebody, this so and so share now belongs to so and so person with other details we'll be discussing a little ahead. So with all these details, there's something called as a share certificate. Till 1996, it was all a hard copy, but later it has turned out to be a soft copy. Soft copy in the sense it's called dematerialization, for short DMAT. So DMAT is like a vault. A vault in the sense a chamber where you can store all your important papers. So DMAT is something like that, which will store data of all your transactions and things in it. So that's like a vault for you. So now a DMAT account is a must. If you need to buy a share, the thing is you need to have a DMAT account for today's world, mandatory. And this DMAT account takes a charge of rupees 6,000. But if at all you want to avoid that, some apps provide it for free. For example, Upstocks. Upstocks is that app which will let you take it for free. Now, for all these stock market and things that we are discussing, is it legal? Is there any, are there any bodies which will regulate all these? Yes. In fact, there are laws which govern these activities. Okay. And the bodies are like SEBI, Security Exchange Board of India, and so on. There are many more other bodies. But for now, SEBI or SEBI is something that we will look into. Not much, but as of now, we just know it is a body which will regulate things. Now, what are the requirements for you to enter into stock market? Other documents that you need? Just two things. One is a PAN card. The other is a bank account associated with it. So with just these two things, you can sign up and enter into the stock market. So now dealing more in depth with stock market. So why people get scared actually to invest in this place? We'll discuss that in detail here. And at the end, later on, we'll be taking up some case studies. But now when we are discussing bits of case studies or some small bits, examples here and there, we'll definitely go through. So first reason is investments in stock market are very risky. People say this, okay? Is it true or not? We'll see. Let's try convincing you how it is and it is not. So now if you consider the performance of Sensex from 1991 to 2018, the Sensex performance, if you consider, in the short term, could there be a possibility that you buy a share and immediately it goes down? The value of that share goes down. In short term, yes, of course. But if you observe in the long run, it is not that risky at all. It is risky only in the short term. Long term, it is doing totally fine, rather. So in the long term, it is showing very good performance. And Sensex in 1991 was less than 5,000. But in 2018, it is almost 35,000. Market can crash here and there. If you observe the Sensex graph, it has ups and downs here and there. So market can crash. The downs represent the market crash actually. But does that mean that it will go to zero? No chance. There is some point in that where it will start bouncing back in the market. There is a point. Every drop says it that it has never reached zero and it cannot reach zero. So there is some point from where it will start regaining the momentum. So most important factor for the stock market is a stable government. So how is government related? Let's see. Suppose there's a party, okay, and they have a few allies, some 3 to 4 allies, and put together they form the government. So now, if the party decides to take any decision or that government takes a decision, but the allies don't agree or they don't support, so then what happens? The government cannot go ahead with the decisions that they thought they could. So definitely market, it has a direct impact on the economy and the market. And definitely there is no stability in the market, which is why if you see from somewhere from the time where NDA came into picture, or what we call as Modi government came in to power, from that time the market value is a little more higher. There is steep upward steep rather in these in the Sensex graph. So it is not because of the BJP that came into power or because Congress lost. It's not because of that. It's just because that they had a government which was stable, which could take up the decisions it wanted to take. So that had an impact in the Sensex or in the economy, and from there it came into the market. So the next thing why, the next reason why people don't get into stock market is you need to have a very strong knowledge about finance. Is it so? No, not at all. If you are from a finance background, yes, it will help you a lot, but many are doing wonders in this market even without that. We cannot say that directly you are entering into this stock market without knowing anything or without having any basic idea of it. No, that is not a safe thing. You need to have some basics, but after that, it is fine. You don't have to be a finance expert or so in it. For example, Mr. Rakesh Jhunjhunwala, who's a CA, okay, he's a chartered accountant, and he says his guru in stock market is Mr. Radhakishan Damani, whose net worth is 7.1 billion USD as of 2019. As of 2019, this was a net worth. Okay, and I'm talking about US dollars. So whatever amount, that is 7.1 billion into 70, you will get it in rupees. So, and what is this Radhakishan Damani's qualification? He's an undergraduate. He's just an undergrad. And ever heard of this name? I doubt. I don't know if you know him or not, but he's the one behind DMAT. Okay, so he is Mr. Radhakishan Damani, the founder of DMAT. So we'll be dealing about him in the later sessions where we have case studies. There are very interesting stories about really interesting people, and we'll study about that there. Okay, and now we'll move to a term. Okay, a very technological term, LTCG for short, known as long-term capital gain. It's one form of a tax, long-term capital gain tax. So what is this tax all about? If you have a share or you buy a share and you hold that share with you for 1 year, and after that 1 year, you sell it anytime after 1 year, maybe 2 years, 2.5 years, anytime you sell it. After you sell, the profit that you make out of that, that is acting as a source of income to you, correct? You're gaining something, it's a profit, so it's like an income to you. Now, if there is an income, there should be a tax. Barabar, correct? Now, but here, when it comes to LTCG, that is a long-term capital gain, you don't have to pay tax. There's a provision in the tax that if it is LTCG, you don't have to pay tax at all. So what is your tax at that time? Zero. Anda, zero. Okay. And successful investors, okay, they earn in double digit or maybe triple digit crores, double or triple digit crores, and paying 0% tax. So tell me, legal or illegal? Legal, obviously, because the government has told LTCG, right? So now, if you invest in shares, what do you get? Dividend. If you invest, so for example, you put an FD, you get something called as return or interest. Here, what is your return in shares? It is called dividend. So how is interest and dividend different? We'll see it now. So interest is usually imposed on FD, that is fixed deposits, or debentures. Okay, another form of fixed deposit. Okay, so these are like financial tools where you get interest. And now, interest, can it vary on FD? Yes, it happens. How? We'll tell you. So it can vary because bank declares the interest rates well in advance. For example, now say on 1st of May, you start your FD, and that time the bank promises 7% rate. Now, somewhere in between, that is say, for example, October, the bank announces, sorry, we are in loss, so we'll be giving you just 5% interest. Is that possible? No, never. At least, say for example, now this same 1st May, whatever your FD started, it completes or the FD matches at on 30th of April. So till 30th of April, whatever was promised when you started, that is 7%, has to be given to you. They cannot change it in between. What the bank can do is October onwards, whoever new investors are there who come and start new FDs on or after October will be given a rate of 5%. Is that possible? Yes, that is possible. So now this rate of interest should go on. It is a fixed rate till the FD matches. So is it mandatory for the banks to give? Yes, it is mandatory. They cannot say no to it. They have to give you an interest. And next thing, very important, is this interest taxable? Of course, it is taxable. So now what is the advantage of dividend over it? So dividend is given on what? On which financial tool? It is shares. Is it mandatory for a company to give you dividends? No, not at all. Why should they? Like really, I will tell you. So there are two companies, Google and Apple. These two companies, though they are making a lot of profits, they don't give dividends at all to their shareholders. Google I'll narrate an interesting story by Google. Okay. So Google's question to its investors was, if we give you dividends, okay, at the rate of $5, okay, 5% in terms of dollars, so you will be given $5 each. So do you have the capacity to reinvest it? Was the question by the Google to these investors or these shareholders. So in US, okay, the FD rate is 2 to 3%. Even their loan rates are quite less, whereas in India, the loan rate is quite high, which is why you'll get FD rate also higher. And there, the FD rate is 2 to 3%. So they said, if you invest this, whatever dividend we give you, that 5%, if you invest it somewhere, it'll only grow at a rate of 2 to 3%. But if you reinvest that in Google or you give it to us and we reinvest it in our company, we'll definitely be able to make, take the growth to a much more higher level. That is possible by Google. So how is it possible? We'll see. They can increase or expand their operations, their services, products. They can work on new products or invent new products. That is also possible. So as they get into more and more ventures, they'll get more and more profits. So more and more profits means share prices also increases. So what is the increase in share price? That is a return to the investors. Okay. So the return to the investors are increasing. Today I bought a share at so and so rate. Okay. And tomorrow, if the share price can increase because of the profits of that company, which has increased, then when I sell, definitely the share price is more. So for me, it is a return, or I'm getting profited again. I'm getting a profit, right? So that is why Google said, you reinvest it with us, we will give you better returns. So that is their policy. Now, is dividend taxable? A very important thing. No, 0% tax. Interesting, right? So it's a 0% tax, but limitations are there. There is limitations. So if you say that you get a dividend of 2 crores, then will I have a 0% tax? No, but there are certain limitations for dividends as well regarding is it a 0% tax or not. We'll deal with it later. We'll not dig deep right now. We'll go with it later. So now we need to know dividend is paid on what? It is paid on face value. So what is face value? We'll deal right now. So is it possible for any company to declare 100% dividend? For example, a particular company, they tell we are doing really well, so we are declaring a 100% dividend. Is it possible? Yes, it is possible. But the question is, 100% of what? This 100% of what? That is a question. Okay, so is it on the market value? Sorry. So is it 100% on the market value? No, definitely no. It is 100% on the face value. For example, you've heard of the company Britannia, right? The biscuit company. Their market value is rupees 3,100 per share. All figures and facts are as of 2019. Okay, so as of then, it was rupees 3,100 per share. So if at all they declare 100%, is it 100% of 3,100? Never, never. Huh? Okay. So 100% of what then? Face value, which is 2 rupees. So what do they mean that you are declaring 100% dividend? You're getting additional 2 rupees. Additional 2 rupees. Okay. So now, what is face value? That is the original price at which the share was brought by the promoters of the company. So now, who are the promoters? Okay, the person who starts the company. So the person who started a particular company, he or she is called as a promoter of that particular company. And at that time, that original price at which that promoter bought the share, that price is called as face value. So we'll deal little more. We'll give you some more insights about it. Okay, so can there be multiple promoters? Yes. How? Can 5 to 10 of us gather together and make a company? Yes. So why not multiple promoters then? Right? Yeah. So now, for example, we all together, okay, we start a company. Now, for that, we will tell as the initial cost, everybody has to contribute 1 lakh. 1 lakh rupees each person will contribute and create a company. Now, we'll name the company as XYZ Limited. Do remember these details because at the end, later stages, we will be taking up case studies where we'll be dealing with these examples as well. So now, you will tell, okay, this 1 lakh I invested here. If I had put it for a fixed deposit or something else, somewhere else, I would have got some return or some interest. So why should I, invest it here? So I bring out the proposal of starting the company. So now I tell, no, don't put it there. You give it to me. We will invest it. We'll create a company. So obviously your question is, what is it that you get? So what is it that you get? Dividend. Because all of you are shareholders, or all of us, including me, are shareholders, and all of us are eligible to get some amount of dividend. And for that, to get the dividend, you need to get the shares, or we need to allocate or divide the shares. So how do we do that? With a share certificate. So now in this share certificate, it will include the details such as your name. I think I had mentioned it earlier that these days it has turned out to be like an e-certificate, which is in the DMAT form. Okay. So now in that, there will be a mention of the face value. Say, for example, we decide the face value as 2 rupees. Who decides this face value? We shareholders. So the company has the right, or the shareholders of the company who started the company, the promoters, they have the right to fix the face value for their own company. So can different companies have different face values? Of course, because there is no fixed rule, or there is no law that governs that this should be the share value, or sorry, face value, or the face value should range between so and so point to so and so point. There is nothing as such. So each company can decide. It can be 2 rupees, it can be 10 rupees, it can be 100, 300, anything. Okay. So let's say, for example, when we start XYZ Limited, we are taking it for 2 rupees. Now, the promoters decided. Now, in the e-certificate or the share certificate, there will be a mention of number of shares that you hold. So how do you take that? The amount that you gave, or the amount that you're investing, that is 1 lakh, divided by face value, that is 2. So what do you get? 1 lakh by 2, 50,000. So each shareholder or each promoter gets 50,000 shares each. Okay. Now, so coming to DMAT, is DMAT mandate? No, not for all companies, but companies which are listed in the stock market, okay, or which are in the stock list. There are many stock lists like national stock list and etc. etc. We'll discuss later in further stages. So at that time, if the company is registered there, then 2019 was the last deadline given to them to convert all the physical shares to DMAT form. That is dematerialization. Whatever was in the hard copy, it is a material. You remove that material, you make it into a digital form, you put it as a data, okay, or you store it in computers and other digital storage places. So then it gets digitalized. So that is called dematerialization. There's another concept, reverse of DMAT, called as remat or rematerialization. It is nothing but whatever is in digital form, you convert it to the material form or hard copy, paper form. It is a very stupid concept these days if you plan to do a remat, because everybody, I mean, the entire world is moving towards digitalization, and there you want to take a remat, which is already in the digital form, you want to take it. It's not a wise decision. So DMAT is mandatory for huge companies or big companies who are making large profits. Say, for example, our XYZ Limited, it started off as a private limited. Okay, it was a private company. Now we've been having many investors and the company grew too big. So it becomes just XYZ Limited. That is, it's a public company. Okay, it gets publicized. So then, yes, it is mandatory for the XYZ Limited to go for a DMAT form. Otherwise, they can even stay with just the hard copy or the paper form of the share. So now, in the annual report of every company, so what is an annual report at the first place? It's like the report card for the company. Okay, so they tell what they have done, what they have not done. Just like how you get, your own report cards or your kids' report cards, like what mischief they have done, what good things they have done, how good they were, how bad they were. Indirectly telling that they are your replica if they are your kids, but it's okay, it's fine, we'll accept it. So here it is just telling that what a group of people did, a replica of what their mindset was. So that will be the progress of the company. So in their annual report, it is mandatory for them to disclose it to the shareholders how many shares are still existing in the physical form. That is, how many of those shares are still not converted to DMAT form. It is a mandate disclosure. Okay. So I think today we have come up with some of the new terms, basic concepts, few examples, and where is this XYZ Limited going up to? We will discuss it in the next episode. So for now, this is just one part of the basics. We'll be covering the remaining in the upcoming sessions. So till then, stay tuned, take care, and meet you in the next episode. Take care. Bye-bye.